Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio by cutting right through market weakness. Today, we're putting a major player in the hotel space under some pretty extreme pressure. We are taking our tools to Park Hotels and Resorts. That's ticker PKR, and we're running a full financial stress test. We're going to find out once and for all if this company is built on solid rock or if we're about to find some very serious cracks in the foundation.
Okay, let's just get right into it, because we have to start with the number that sent shockwaves across the trading terminals. For the full year 2025, Park Hotels reported a net loss attributable to its stockholders of $283 million. I want you to just let that sink in for a second. A company that literally owns some of the most iconic premium hotels in the entire country is posting a loss of over $250 million. I mean, this is the exact kind of headline that makes investors just slam the sell button and run for the exits.
Whoa, hold on a minute. Bleeding out? Lead analyst, this looks more like a gusher. Negative $283 million is not a paper cut. That's a gaping wound right there on the income statement. You know, when a company with assets that are supposed to be this premium, this high quality, is losing that kind of cash, the immediate question, the only question, has to be, is the entire structure here fundamentally unsound? Are we literally watching a slow-motion collapse?
And that is the core question we have to answer today. To do it right, we need a blueprint, so here's how we're going to attack this. We'll start by looking right past the fancy facade to see what's really going on. Then, we're cracking open the books. After that, we'll separate the core from the rot in their portfolio, we will stress test their massive debt load, and finally, we'll analyze the all-important shareholder payout before we deliver the final iron verdict.
All right, let's get to work. Now, before we start drilling down and getting our hands dirty with the numbers, we really need to understand what we're looking at here. What is the public face of Park Hotels and Resorts? I mean, what does this company actually own that gives it its reputation?
So let's be crystal clear about this. This is not some portfolio of roadside motels off the interstate. Not at all. Park is one of the absolute largest publicly traded lodging REITs. They own 34 premium, often iconic hotels in what they call prime locations. We're talking about A-list real estate like the Hilton Hawaiian Village, for example. So yeah, the facade is impressive, it's grand, but we're not here to admire the paint job. We are here to test the foundation.
And that brings us right to the heavy lifting, that jarring, ugly, negative $283 million number. Now, in the world of real estate investment trusts, or REITs, you have to know that GAAP accounting, that's the official by-the-book numbers, can sometimes be really misleading. In fact, they often mask the true cash-generating power of the business. So let's crack open these books and find out if that loss is a fatal design flaw or if it's maybe just a cosmetic issue.
This slide right here shows you the profound disconnect we're talking about. It's night and day. The market, the headlines, they all see that GAAP net loss of negative $283 million. But if you listen to management, they point you to something else entirely. Their adjusted funds from operations, or FFO, which comes in at a positive $394 million. That is a nearly $700 million swing. It's just massive. One number signals a total collapse, the other points to a healthy cash machine. To figure out what's real, you have to understand why REITs even use FFO. It's because they own these enormous physical assets, and standard accounting forces them to take huge non-cash depreciation charges every single year. This can artificially crush their net income. FFO simply adds that depreciation back in to give you a clearer picture of the actual cash flow. So, the big question is, which one of these numbers is telling the true story?
And the answer? The entire key to unlocking this puzzle lies in this one single accounting term, an impairment charge. It is absolutely crucial that you understand what this is. This is a non-cash expense. I'll say it again, no money is actually leaving the company's bank account. This is just the accountants on paper acknowledging that an asset on the balance sheet, in this case one of their hotels, is no longer worth what it was previously valued at on the books. So they have to write down its value, and that write-down slams the income statement as a massive expense, even though it's really just an entry in a ledger.
In this slide right here, this is the smoking gun. This illustrates the entire story. The culprit behind that scary $283 million loss is a single $318 million impairment charge. So you see, this non-cash charge is actually larger than the entire net loss. That means the company would have been profitable even on a GAAP basis without it. And this is the most important part. This charge was taken specifically against assets that the company itself has labeled non-core.
So let's just follow the money on their own reconciliation table. It's pretty straightforward when you see it laid out. They start with that headline, net loss of negative $283 million. Then, look what they do. They add back the big non-cash expenses. There's the $336 million for standard depreciation, and then there it is, the huge $318 million impairment loss we just talked about. After a few more tweaks for other items they consider non-recurring or one-time, you land right at their preferred metric. Adjusted FFO of $394 million. The math is clear as day. The reported loss is an accounting construct. It is not a cash reality.
Okay, I see the math, I get it, but I'm not sold, not by a long shot. This feels like a classic case of financial sleight of hand. You know, look over here at this shiny number, not over there at the ugly one. Every struggling company on the planet has its own special adjusted earnings metric. So are we absolutely sure this isn't just financial engineering? Isn't this just a way for management to paint over some very, very real cracks? I mean, they're literally telling the market that a big chunk of their assets are worth $318 million less than they thought. That sounds like a pretty fundamental problem to me. Whether cash physically left the building this quarter or not, it's a direct admission of a major past mistake.
You know what? That is a completely fair challenge. 100%. Is this just a sophisticated way to manage the books, or is it a desperate attempt to hide some serious weakness? To find out, we have to move beyond the accounting games and look at the operational engine itself. See, management's entire strategy is to draw a hard line in their portfolio, separating the strong assets from the weak ones. It's a strategy of focusing on the core and, well, cutting out what they see as the rot.
And this slide right here lays out that strategy perfectly. On the left, you've got the core hotels. Think of these as the main load-bearing beams of the entire company. And they're seeing really strong performance. RevPAR, that's revenue per available room, the absolute key metric in the hotel industry, grew a healthy 3.2% in the fourth quarter. This is where they're seeing strong group and business demand, and it's where they're reinvesting their capital. Then on the right, you have the non-core hotels. These are the problem children. These are the assets they just wrote down by $318 million. And the plan isn't to fix them. It's to get rid of them. They are actively selling these properties off to generate cash, which they then funnel right back into renovating and strengthening that core portfolio. It's a classic asset recycling strategy.
And you know, the strength of that core engine is actually even more impressive when you dig just a little bit deeper. That 3.2% growth in Q4 RevPAR we mentioned, well, it's actually being held back. That's because one of their hotels, the Royal Palm down in Miami, was completely shut down for a massive renovation. If you simply exclude that one property from the calculation, the rest of the core portfolio saw RevPAR grow by a very impressive 5.7%. That really demonstrates that the underlying operational engine here is strong and it seems to be accelerating.
Okay, so they're renovating the main house by selling off the guest house and the garage. I get the concept. People call it pruning the portfolio. But my question is, when does strategic pruning become a desperate fire sale? It's great that the remaining assets are performing well, but let's be honest, they are shrinking the company's overall footprint and its asset base to get it done. Is this a brilliant long-term strategy to fortify the whole structure, or are they just selling off assets to survive and to paper over some big balance sheet problems?
That's an excellent question. And the answer to that question lies deep beneath the surface, in the company's very foundation, its balance sheet. Because look, you can have the best performing, most beautiful hotels in the world, but if they're built on a mountain of crumbling debt, the entire structure is at risk of collapse. So let's move our stress test to that debt load.
The sheer scale of the liabilities here is staggering. At the end of 2025, Park's total net debt stood at over $3.7 billion. That is a massive, massive anvil hanging over this company's earnings day in and day out, weighing everything down.
But, you know, that raw number, as big as it is, doesn't tell the full story. To truly test the foundation, you have to measure that debt relative to the company's ability to actually pay it off. And this chart, well, this chart shows a deeply concerning trend. The net debt to adjusted EBITDA, a key measure of leverage, it's moving in the wrong direction. It has climbed from an already high 5.61 times in 2024 to an even more worrying 6.15 times in 2025. This means the debt burden is getting heavier and heavier relative to the company's earnings. This is a classic sign of increasing financial risk.
615X is a major red flag. That's a very, very heavy load for any company to carry. But the real danger here is in the fine print, the part a lot of people miss. According to their own filings, they have $1.4 billion of mortgage debt maturing in 2026. They have to refinance that. And in the current interest rate environment, that is a massive risk. What happens if interest rates don't come down? If they're forced to roll that $1.5 billion in debt at significantly higher rates, that new interest expense will directly attack their cash flow. This isn't some hypothetical crack. This is a visible stress fracture in the foundation that they're driving straight towards. You are exactly right. That upcoming debt wall is a critical risk factor we cannot ignore. And the pressure it's going to put on their cash flow leads directly to our next stress test. And for many investors, let's be honest, this is the most important one: the shareholder payout. The dividend is the primary reason people invest in REITs in the first place. So we have to ask, is Park's dividend built on a solid foundation, or is it just some temporary scaffolding that could be taken down at any moment?
Let's walk through the dividend history, because it really tells a fascinating story. Looking at this timeline, what you see is extreme volatility. I mean, look at 2022, a tiny 28 cents for the entire year. Then in 2023, it explodes to $2.15 per share. But that was juiced by huge special dividends, which were almost certainly funded by those asset sales we've been talking about. Then 2024 comes back down to earth at $1.40. But now look at what they did in 2025. They established a clear pattern, a consistent, predictable 25 cents every single quarter, for a total of $1 for the year. And they've already declared that same 25 cents for the first quarter of 2026. It's obvious what they're doing. After years of wild swings, they are desperately trying to project an image of stability and reliability to income investors.
That stability looks nice on a chart, but is it sustainable, or is it just another facade? I mean, they are guiding for their adjusted FFO to decline in 2026. They're telling us it's going to drop from $1.97 per share in 2025 to a range of somewhere between $1.73 and $1.89. So let's just connect the dots here, shall we? Their profits are guided down, their leverage is already high and it's rising, and they have a $1.4 billion debt wall to climb in a really tough interest rate environment. How can they possibly guarantee that $1 per share dividend is safe? It really feels like something has to give.
And that, right there, is the billion-dollar question. We've now stress-tested their income statement, we've examined the balance sheet, and we've put the dividend policy under the microscope. We've inspected the glamour of their core assets and the rot of their non-core disposals. Now it's time to assemble all the data points, weigh the structural supports against all the visible cracks, and deliver the iron verdict. Is Park Hotels & Resorts a fortified opportunity, or is it a crumbling value trap?
Look, you absolutely cannot deny the quality of the real estate. I mean, these are iconic, market-leading hotels in top-tier locations that generate a ton of cash flow. The assets themselves, the physical buildings, they are solid. But I have to say, you can have the most beautiful building in the entire city, and if the mortgage is crushing you, it is a bad investment. We are not questioning the facade, we are questioning the integrity of the underlying financial structure that's holding it all up.
And we are not the only ones asking these hard questions. Just take a look at the sentiment coming out of Wall Street. This is not exactly a strong vote of confidence, is it? Out of 13 professional analysts covering this stock, only 2 of them rated a buy. 8, the vast majority, are sitting on the fence with a hold rating, and 3 are actively telling their clients to sell. The consensus rating from MarketBeat is literally reduce. And Zacks Investment Research, well, they've gone even further, slapping a strong sell rating on the stock. When the pros on the street are this divided and leaning this bearish, retail investors need to proceed with extreme caution.
Okay, let's lay it all out on the final blueprint. This is it. These are the results of our stress test. The structural supports, what the bulls are hanging their hats on, they're undeniable. That core portfolio is the engine and is running strong. Management has a clear and logical strategy to sell off the weaker assets to strengthen that core. And yes, if you look past the GAAP accounting noise, the adjusted FFO shows that this is a business that generates a lot of cash. And that cash has allowed them to stabilize the dividend at what is, for now, a very attractive yield. But then there are the cracks in the armor, and they are serious. That massive GAAP loss, while non-cash, is a big red flag that cash investments have soured. The leverage is the biggest crack of all. It's high, it's rising, and it's heading straight for a refinancing wall. Their own forecasts point to lower profits next year. The dividends history is choppy and unreliable, and Wall Street is clearly nervous. So what is the iron verdict? Is this a structurally sound investment, or is it a value trap showing some serious signs of rust? From a purely operational standpoint, I don't think this company is on the verge of collapse. The core engine is strong, but that balance sheet, it is a significant structural weakness. A leverage ratio over 6 times with a massive refinancing on the horizon is a huge risk. For me, the verdict is a high-risk hold. The dividend is your compensation for taking that risk, but you have to watch that balance sheet like a hawk. I'm calling it a value trap. Plain and simple. That attractive dividend yield is the bait.
The combination of rising leverage, declining profit guidance, and that looming debt wall is a toxic cocktail just waiting to happen. Selling assets is a short-term fix, but it shrinks your long-term earnings base. The analyst community is cautious, and you know what? They're right to be. There are stronger foundations out there to build a portfolio on. So the final question for you is this: are you really being paid enough by that dividend to risk a painful and very costly financial renovation?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.